Hello, and welcome to this special edition of CBTV. I'm Matthew J. Rettick, the host of Checks and Balances TV. Today, I'll be presenting our newest installment of the Truth About series. We have an exciting yet controversial topic to discuss, which millions of Americans own today: stocks. So get ready for the truth about stocks. I'm going to share with you the pros and cons, both sides of the coin, the advantages and disadvantages of this useful but many times misunderstood financial product. By the way, you can download our free report, The Truth About Stocks, in the download section of our website. Much has been written over the years about the history and benefits of investing in stocks, and most of it is true. But some of it is not relevant to you and your future based on your current age and risk tolerance. What I will do today is boil down the most important common truths about stocks in a way that will reveal the basic pros and cons of this very important investment vehicle. Now, first of all, what is a stock? Well, a stock is a piece of a company. When you own a stock, you own a stake in that company. The more shares you own, the more of that company you own. When most people think about stocks, they tend to think about stocks bought and sold in the stock market. There are, however, many stock markets today. The one you may have heard of the most is the New York Stock Exchange. You've probably seen it as the backdrop from which the financial news is delivered every day. And that is one place where stocks are bought and sold, but there are many, many more. Now, why invest in stocks? The simplest answer is to grow wealth. It's been said that stocks are the best investment there is. Some have even said that investing in stocks is the only way to stay ahead of inflation. But be careful, investing in stocks is not a sure bet that you will make money. Now, there are two different types of stock: newly issued stock and publicly traded stock. Let's talk about the newly issued stock. In general, a company sells stock when it wants to raise money. To get access to additional capital, the company will offer shares of the stock and sell them to the public at what's called an IPO, or initial public offering. Now, once stock is bought directly from the company, it is then sold and bought or traded between investors. And then we have the publicly traded stock. The stock that most of us commonly think of is traded in the public. That means that there's some place where sellers and buyers come together to exchange stock. These are known as stock exchanges. And the most common ones in the U.S. are the New York Stock Exchange, the American Stock Exchange, and the NASDAQ. There are also smaller stock exchanges throughout the country, as well as foreign stock exchanges in virtually every country on earth. When a company issues new stock, it sets the price. Once it's bought by investors, the price is then set based on what investors think it's worth when they go to buy or sell it in the future. Again, for even more information about stocks, download our free report, The Truth About Stocks. Now, here's an important question: how much do stocks return? Well, that's really the $64,000 question. The answer, as with so much about stocks, is that it's not so simple to quantify. If you ask a stockbroker what the average annualized rate of return on stocks is, he or she might tell you that it's around 10 to 11%. As a matter of fact, a popular national radio show host touts on his radio show that all you got to do is go out and find yourself a good 12% mutual fund. Believe me, it's not that easy. However, if you use the Dow Jones Industrial Average as the yardstick for the American Stock Exchange, the truth is that from 1900 to the present time, the stock market has gained an average of about 5% per year. Well, how can that be? Simple. If you had invested in the Dow Jones in 1900, it was about 64 points. At the time of this recording in February 2011, it's roughly at about 12,000. So to get from 64 to 12,000 over 111 years, you would earn close to 5% per year. But that's not the whole story, because if you had invested back in 1900, you would have received dividends from some of those Dow stocks. And many experts agree that dividends add about 2% of the total return of stocks. So 2% plus about 5% historically makes 7%. But bear in mind that that was over a 111-year period. No investor has a 111-year time investment horizon. So if you look at shorter time periods, you will get wildly different results. So the answer to how much do stocks return has as much to do with when you start and finish as to how successful you are at picking the right stocks. Now let's talk about the risk of owning stocks. The risk is simple. You could lose everything. In reality, that doesn't happen most of the time. Fortunately, the Enrons and WorldComs of the world are the exception and not the rule. But you don't have to lose everything to lose a bundle of money. Since a stock is a piece of a company, if the company goes bust, it doesn't matter how much of that company you owned. 100% of nothing is still nothing. But let's talk about the reward of owning stocks. This is why people take the risk. The reward is that the value of a stock can increase literally forever. People buy stock because they think or hope that the price will go up in value in the future, so that in the future when they sell it, they'll make a handsome profit. But let's talk about taxes due on stock gains. In general, if you buy a stock today for, let's say, $10 and it goes up in price to $25, you do not owe any taxes unless you sell it. If you do decide to sell it, then your gain of $15 would be taxed at the capital gains tax rate in effect at that time. Under current tax law, there are two different tax brackets for capital gains: a short-term capital gains tax for stocks held for less than 1 year, and a long-term capital gains tax if you held the stock for at least 1 year or longer. Currently, if you buy and then sell a stock within 1 year, your short-term capital gains tax rate will be whatever your ordinary tax rate is for the year, which could be anywhere from as low as 10% to as high as 35%. If, however, you buy and then hold a stock for over 1 year, the long-term capital gains tax rate is 15%. Unless you are in a 10% or 15% ordinary income tax bracket. And if you are, then you will pay zero taxes on the gain of that stock if you sell it. Now let's talk about dividends. Some companies pay dividends to the owners of their stock. Think of it as a sort of profit sharing for the owners of the company. If the company has a good year and has extra money left over after paying all of its obligations, it can and often does pay the stockholders some cash. These payments are known as dividends, and they are taxed most often as ordinary income. Dividends are not guaranteed, though. They can and do fluctuate over time with the success of the company. And remember, for even more information about stocks, download our free report, The Truth About Stocks. Now let's talk about the different ways to categorize stocks. There are many ways to categorize stock, but here are some of the most common. First of all, by the size of the company. If a company is a huge company, meaning the total value of all the shares of stock that are owned are greater than $10 billion, then that company is known as a large cap stock. Large cap means large capitalization, which means the number of shares that are owned times the value of each share. Large cap stocks are generally well-known companies. Microsoft, ExxonMobil, General Electric are examples of large cap stocks. Medium-sized companies, or mid-cap, are those that have a total value of stock outstanding between $1 billion and $10 billion. These are lesser-known companies, but you may have heard of some of them. Small caps, or small companies, have less than $1 billion in outstanding stock. The second type of categorization is the growth versus value stock. Now, a growth stock is a company whose stock you think is going to grow like a weed. During the internet and tech bubble, most of these companies were growth stocks. A growth company is usually a younger company. Think about Microsoft 30 years ago. In their early years, Microsoft generated huge growth for the people who bought their stock. Now, a value stock is usually the stock of a company that you think is temporarily undervalued. There might have been some bad news about the company or stock, and the stock price dropped as a result. Value companies also tend to be more mature companies. So you may consider buying it now because you believe the stock will increase in the future with the current selling price below what you think it should be. The next way to categorize stock is looking at common stock versus preferred stock. So far, we've talked about the most common types of stock, which is known as common stock. There is also another type of stock, though, known as preferred stock. This type of stock receives preferential treatment when the company pays dividends. As a quick review, if you own common stock, a company can pay a dividend to the owners of that stock, which of course is you. But dividends are never guaranteed and can vary at the will and whim of the company. Now, with preferred stock, however, you are assured that before the company can pay a penny in dividends to common stock owners, they must first pay a dividend to the owners of its preferred stock. A preferred stock is often quoted by its dividend yield, such as an IBM 5% preferred, meaning that it pays a 5% dividend. That dividend yield is based on the price of the preferred stock when it was first sold by the company. And preferred stocks usually have a fixed price, which is most often $25 per share, but can also be sold at $50 and $100 per share, depending on the company. The next way of categorizing stocks is by financial ratios. Now, this could be a whole nother special edition of CPTV itself. But there is at least one financial ratio that you should understand very well, and that is the PE ratio. P stands for price, and E stands for earnings. The best way to understand this is by an example. Let's say I owned an ice cream store, and after paying all of my employees and expenses, I earned $100,000 per year from the store. And one day a man walks in, sees what a great store I have, and offers me $2 million in cash if I'll sell the store to him. Well, what would you do? Well, for me, I'd take the money and run. In that example, the earnings are $100,000 and the price is $2 million. So that's a PE ratio of 20. That means the buyer is willing to pay me 20 times in cash for the amount I'm earning every year. Now, does that sound like a low price or a high price to you? In my opinion, that's a very high price. Yet the PE current ratio of the U.S. stock market is in the neighborhood of 18. Why is this important to know? Because historically, when stocks go up for long periods of time, the PE ratio of the broad stock market is not only less than 10, it's usually closer to 8. And from that one fact alone, you can know quite a lot about an individual company. Once more, for even more information about stocks, download our free report, The Truth About Stocks. Now let's talk about a very important topic, and that's diversification. You've heard it before, don't put all of your eggs in one basket, which of course is very sound advice, because if that basket tips over and all of your eggs spill out, they could certainly break. The same is true about investing in stocks. The concept behind diversification is simple. Spread your money around among many different categories of stock, so that if one sinks like a rock, the rest of your portfolio will hopefully do better. While the concept is simple, doing an effective job of diversifying investments is not an easy job. First, you should realize that not all of your investments should even go into stocks. You should have some money in cash, bonds, real estate, annuities, and perhaps precious metals like gold and silver. Diversification, also known as asset allocation, is an entire field of study itself, so I won't try to tackle it in depth at this time. But I do want to touch on selling stocks short and also long. Most people think that the only way to make money in the stock market is to buy a stock, wait for the share price to rise, and then sell it to make a profit. What many people don't know is there is another way to profit from buying and selling stocks short. When a stock purchaser goes long on a stock, it means that he or she believes the stock is going to rise in price in the future. On the other hand, when a stock purchaser goes short, he or she is anticipating a decrease in share price in the future. Now, here's a very big warning. Selling short in the stock market is one of the riskiest and most complicated ways to make money in the market, and not usually suggested for the average investor. Now let's talk about one of the newer ways of investing with ETFs, which is a single stock that contains a basket of stocks. Let's say you don't have a lot of money to invest, but you'd like to diversify your portfolio of stocks, yet you don't like the many downsides of mutual funds. Enter in exchange-traded funds, also known as ETFs. Now, an ETF is a basket of stocks that trades just like a single stock. It has its own ticker. You can buy and sell them throughout the day. They tend to have very low expense ratios, and best of all, many ETFs do not generate yearly taxable distributions or 1099s. More than that, ETFs allow you to buy all the stocks in the big stock market indexes, like the S&P 500, the Dow Jones Industrial Average, foreign countries, and many other categories, all in one fell swoop with a single trade. I'll tell you more about the pros and cons of buying and selling ETFs in the future The Truth About ETFs special edition of CBTV. So be on the lookout for this upcoming in-depth review. There's so much to know about stocks that I have really only scratched the surface here. But after reviewing this presentation, you at least know the basics. Investing in stocks can be a very financially rewarding endeavor, or they can give you a big headache that can last for a very long time. If you plan to invest in stocks, take the time to do a lot of reading and studying. Take your time. Learn as much as you can about that company before you invest your hard-earned dollars. Learn about the people who run the company, how long they've been there, and what they did before they joined the firm. Learn how to read a balance sheet and profit and loss statement. Look at the dividend track record if they have one. The bottom line here is do your research before you invest your money. As a final thought, if you're going to purchase any type of stock, consider working with a competent professional financial advisor who can help you navigate through all the different options out there. Also, be sure to request your free copy of The Truth About Stocks by logging on to our website and downloading this in-depth report. We want to arm you with the truth about this important financial product so you'll know if it's the right investment for you. And revisit the download section of our website for additional information and other The Truth About reports and series on many popular investment products available today. And as a quick reminder, be sure to watch a new edition of Checks and Balances TV every Wednesday at 4 p.m. Eastern Standard Time for the balanced truth you need to find